Hey guys, before we get into today's episode, I just want to remind you that we are going to be doing a breakout session for BDOs at the Mid Americas Lenders Conference in Houston, Texas on April 15th, my son's birthday. If you want to level up your game in 2025, come see us live in person at MALC. The link to register is in the show notes, and we will see you there.
Warning. The views and opinions expressed in this program are our own and/or those of our guests. They do not necessarily reflect the views or positions of our employers. Viewers' discretion is advised.
Nobody wants to be that borrower. Nobody wants to be that lender that closes a deal and then 3 to 6 months later, they don't have any room to stub their toe and they're coming back to the well for more money.
So a lot of times this kind of comes down to a common sense situation.
Like, let's not forget when my money was jammed up and I got that great advice from Jared Johnson. Tap your 401k and go close a loan.
It's very important as a BDO to be mindful of
I had a customer sell crack to get liquidity.
Well, the Metro Detroit's
I did. You think I'm playing? He's in jail right now. And we're liquidating.
Crack rock or booty crack?
No, it was crack rock out of his store. We're in the process of liquidation right now.
Booty crack.
Ray, just cancel us already. We're begging you. Cancel us.
Hey man, it happens. Sometimes you need a little extra cash on the side.
Cancel this show. Cancel it.
I'll tell you what. If Elon crashes the SBA, I'm grabbing the Digi and getting back to work, son.
Let's go.
Hey everyone, welcome back to the BDO Show, a podcast for passionate BDOs wanting to level up their game with advice and stories from battle-tested BDOs. I'm your co-host, Emily Detor, and I'm here with my fellow co-hosts, Alan Peterson, Chris Hackney, Sterling Birdsong, and Ryan Kroge. At the beginning of each episode, we will remind you to smash that like button, subscribe, and share with your friends, coworkers, and whoever you're around. And also do not forget to check out our whole family of shows, SBA Today, which airs live every week on LinkedIn, as well as our flagship program, the Art of SBA Lending Podcast. And do not forget to send your topics and suggestions over to the BDO Show at artofsba.com. BDOs. Have you ever had a borrower bring in like a brother-in-law to do their life insurance? Doesn't end well, does it? We've all been there. When you require life insurance on your SBA loan, it's critical that you bring in a company that specializes in getting these policies in place for the SBA loans. The last thing you want is for life insurance to be the holdup. We all know that's a rookie mistake. SBA Protection Quick Close Life Insurance is the fastest, easiest way to secure the insurance protection that your borrower needs for their SBA loan. Their process is simple, hassle-free, and only takes a few minutes of your borrower's time. No lengthy paperwork, no complicated forms. They even have programs that don't require labs or doctor records for approval. And best of all, you will have the collateral assignment back in less than 24 hours. It's a no-brainer. Go to sbaprotection.com for more information or email Adam Bergen at adam@sbaprotection.com. Today's episode, we did one in early 2024, which we called Cream. Cash was everything around me, but that was part one. Now we're going to go into part two. In 2025, let's talk about liquidity, specifically in SBA lending. Obviously, we don't want to, just pigeonhole to one subject or just one type of loan. So, Alan, why don't you go ahead and kick us off? Let's talk about liquidity first and requirements for SBA in general, and how do you explain that to borrowers?
For me, personal liquidity or post-close liquidity really matters the most when, depending on the total use of proceeds. In short, to break it down in really basic terms, we want to know that, you have some cash outside of this business venture, this project. You know what I'm saying? If you can put, 10 down on an SBA loan, but it's your entire life savings and there's any issue, during the beginning of the transition, if you're purchasing a business, if you're starting a business, if it's a franchise startup, if it's a variety of things that you could be doing, you got to have some cash to support your own personal debt obligations as they're defined by your credit report, right? So it's hard to say that, there's one set number, because what I really look at is, the total picture. I don't have a hard rule of I need 10% post-close liquidity no matter what, or I can't do the deal. However, I do want to see sufficient post-close liquidity of generally at a minimum for me personally, it's 5% of the total project or 3 payments cash or cash equivalent on hand. I think it is right. Some, people disagree. I think it's okay to count retirement monies and 401k proceeds as cash equivalent because in the event of emergency, break glass in case of emergency, it's still your money. Like, let's not forget when my money was jammed up and I got that great advice from Jared Johnson, tap your 401k and go close a loan. I was able to grab that cash and bailed me out. And there might have been tax implications, but luckily we call my accountant the chef. But that's for another episode. What about you guys? How do you feel about liquidity?
Well, thankfully you had an amazing 2024, so you were able to pay that back pretty quick there, Al.
That's true.
So, what I would say is that a lot of this stuff kind of comes down to being more of an art than a science, because oftentimes there's no set liquidity ratio that a bank is going to make a customer hit. There are some banks out there that are more, hey, either it fits this box or it doesn't fit this box. But for the most part, most banks are going to look at a situation and they're going to say, hey, in an ideal world, I would love it if a borrower had 10% post closing liquidity. But let's be honest, there's the real world and there's the ideal world, and they're not always the same thing. And in the real world, oftentimes you're going to have transactions where someone's not quite going to have 10% post closing liquidity. And does that necessarily make it a bad deal? Well, it would depend on a lot of different factors. And that's why this is more of an art than a science. I mean, if this is an acquisition or an expansion deal, for example, maybe you're a little bit more comfortable with the fact they don't have 10% post close liquidity. If there's somebody who has a ton of industry experience, maybe you're more comfortable with that. If there's a ton of collateral, that's going to make the deal more airtight on the bank side. There's different scenarios. And so a lot of times this kind of comes down to a common sense situation where, you as a banker, you as a BDO should be able to look at a situation and say, hey, would a reasonable underwriter approve this? Would an underwriter look at this and say, hey, you know what? This guy's going to have $5,000 left over after he puts in his $100,000 equity injection. Yet that might be a problem. That's probably going to be an issue. Whereas if he maybe had 50,000 after he put his 100,000 down, so he's around 5%, then there's probably something that you can get behind as a banker. And so this is one of those situations where you as the lender really need to understand your deal, understand what the other mitigating factors are, and then make an educated decision. And then hopefully you'll be able to back it up when you talk to your credit committee.
We're not going to talk about the package that Kroge just got at his house. We saw the UPS guy walking down your driveway in the background. Yeah, what is that? Can we know? Or
actually,
I was about to
I'll
go
let
down.
you guys know right now. I think I know what it is.
Cash.
Well, extra
Are we
price.
doing unboxings now on the BDO show?
This is what you do
Sponsored product placement.
when you drink too much and you're on TikTok. You buy the stuff on the show. So I got new deodorant. I'm gonna check it out.
Bro, I
What?
have
TikTok
that
shop
already.
got
I bought.
you?
Mando.
It's called Mando.
I have that same.
This stuff.
I got the
you
Mando.
have
We're
this
now
stuff?
sponsored.
I have that
Is it
stuff.
good?
Sponsored by
Is it pretty
Mando.
good? Yeah, I've heard a lot of good
It's
stuff
great.
about it, so I wanted to check it out. And I got
This is why
3
boomers shouldn't
bottles,
be allowed on
baby.
social media.
You went
I
3
went
bottles
3
in
deep.
on the first buy?
Yeah,
He never
anybody
even smelled
using
it.
Mando,
It was on TikTok.
make
He
sure-
said, I need 3 of those.
I said, are
You
you
gotta-
kidding me? It was like 3 for 2. So I'm like, I'm gonna get one of each of the flavors. I'm gonna check it out.
He's got a
Don't forget
subscription
to
Mando
Is that
use
spray on the
offer
Yeah, spray
code
on, baby.
Barry Sanders to get 22% off. That's right.
Actually, that
Offer
smells pretty
I don't
code
think
good.
I've ever
Barry
used spray-on
Sanders
deodorant in my
for
life.
22%
Barry
off.
Sanders.
I
Your
like
first
the
used
one.
spray
spray-on
on because
deodorant
I
since
like
I
to
used
feel
Axe spray in middle
the
school.
ting from the alcohol.
You don't care about aerosol in the environment.
No,
Look at you.
man.
You don't care. You guys are burning coal out there for fun in Detroit.
That's what
you
we
don't
do,
care.
baby.
You're not hugging trees.
So the hole in the
Yeah,
ozone is right
Tesla.
above Detroit.
No more Teslas now that
Hey,
Elon's
I'm
trying
gonna
to
tell
pull the
you
plug
right
on
now.
the SBA.
Of all the
Speaking of-
deals that I've done here in Detroit, Orms thinks that Detroit just glows at night with every phase 2 that I have to do on every deal.
All right, we got to bring it back on track. Chris, what do you think about liquidity?
Well, there are no liquidity requirements technically from the SBA SOP. It varies from bank to bank depending on your bank or the bank that you're working with or for. Liquidity is less or more important. Some banks are collateral driven. As long as they have, a condo in New Jersey, as Alan always says, they're fine. Some banks are cash flow driven. But liquidity, I think, is important for peace of mind. If I was a borrower buying a business, I do applaud the confidence of some borrowers that are buying businesses that, are $1 million, $500,000, and they have a couple, pennies or dollars to rub together. I'd be focused on building up my own liquidity. but maybe they're leveraging their experience. But I think liquidity is important for you as a person or as a buyer, or particularly as a BDO, to have peace of mind after you buy that business. How do you mitigate some of the transition risk? Acquisitions in particular, they're not all roses. Once you buy a business, things happen. Once you start a business, if you're financing leasehold improvements and you think that business is going to take 6 months to ramp up and you're going to be at full capacity, full occupancy, it rarely ever works out like that. So if you have a decent amount of liquidity, that's like, okay, my family's good. I'm not stressed out about running this new business now. I can take a couple more months and figure some things out in the business. So it's very important as a BDO to be mindful of, okay, what am I financing? What's the transition risk? What's the ramp up time? Be realistic. Maybe add 2 or 3 months for a startup project because things happen again with construction and delays. Add some working capital into the deal, do an interest only period as well to help your borrower out, and really pay attention to that liquidity, because just because you can get a deal done on cash flow, liquidity is the reason why a lot of loans don't make it to full repayment. It's not due to lack of cash flow, it's due to lack of liquidity, and they don't have the cash to fill in seasonality or gaps or when things happen and then they just fold.
I like to lend it. I like to lend to post closing liquidity. So I'll try to take a borrower and try to fit a structure that meets their liquidity needs, whatever liquidity they have on hand. If they've got 5%, 10%, 15%, however much they want to put down, anything above and beyond, it, I'm with Al. You got to have at least 5% post closing liquidity. I try to push it to 10, but I'll lend it. If the cash flow can support it, I'll throw it into cash flow, and I'll throw it on the loan and let the cash flow service that debt and give them liquidity right after closing. Now, if I run into a problem where I've got an individual putting 10% down, the seller won't take a promissory note, and that's draining their liquidity, and I'm at a point where I'm at like 1.25, 1.3, and I'm like, I really can't lend you additional liquidity, then we got a problem. Now we got to talk about adding additional guarantors. We got to talk about restructuring things, try to force a seller note, because you got to have liquidity. Nobody wants to be that borrower. Nobody wants to be that lender that closes a deal and then 3 to 6 months later, they don't have any room to stub their toe and they're coming back to the well for more money. You don't want that to happen. You've got to make sure that your customers' needs are met and their liquidity needs are met, especially in retail or anything that's capital intensive. You've got to make sure that they've got cash up front, because remember, when you're doing a business acquisition, all that cash that's on the balance sheet, it's gone. All right, that's going with the seller. So if they're normally carrying $200,000-$300,000 worth of liquidity on the balance sheet and that's keeping them going, best believe they're going to need that at least for the next 3 to 6 months to get through their ramp up period to where their receivables converts into organically built working capital to be able to keep that machine humming, right? So you got to make sure that they got that post closing liquidity.
To Chris's point too, it's undercapitalization really is the number one offender. Like when things are getting tough, that's what it is. I'd rather overfund if at all possible, right? Like Chris said, okay, they're anticipating that they'll be in a good spot in 90 days. Well, why don't we call it 120 days safely, and things like that. I think that's really the difference. I mean, we have the ability to offer lines of credit. That's always a good thing. That way, you have access, but you do not necessarily need to start paying on that money day one. But we don't throw lines of credit on every deal. It doesn't always make sense, right? So I'm with all that. And I think ultimately too, it's a matter of making sure that people are doing the right due diligence and we have a good forecast of what the working capital need is and what is their personal debt obligations as well, and combining it, that's the answer. I don't think it should be a hard rule, but it definitely needs to be considered.
It also helps that know your borrower, know the borrower's industry. Since the majority of my transactions are either restaurants, liquor stores, grocery stores, or gas stations,
They are?
just a little bit. I have a tendency to know those industries pretty well, so I could take a look at a balance sheet when it's being acquired and know whether it's lacking liquidity or inventory. Inventory, especially whether you're dealing with a restaurant, liquor store, gas station, whatever. A lot of times, in order to be able to reduce a purchase price to a certain level to get cash flow to work, you'll have a seller just squeeze the inventory down as little as possible to be able to squeeze as much dollars out to get a sale done, right? Well, that doesn't exactly work very well for the buyer. And as a lender, you need to know what you're looking at. You need to know and say, all right, I'm looking at a liquor store that does $2 million in revenues a year. I know at a bare minimum, baseline's got to have $400,000 worth of inventory on the books. If it doesn't, we got a problem, baby. If you got $100,000, $200,000 on the books when you're acquiring it, they will be coming back asking for more money within 3 months. So you've got to be able to work that in. You've got to be able to negotiate with the seller and basically counsel the buyer, hey, man, you're buying this store. It is way undercapitalized. You don't have enough inventory. You're going to be stuck. So we're going to have to find a way to work with the seller to increase that inventory and reduce the price, or get you some working capital one way or another to build that inventory back up.
For years, SBA lenders have relied on referral sources because, let's be honest, reaching businesses directly is just not how the industry worked. It was too hard to find the right contact info, and when you did, actually getting them to engage felt impossible. When Ray first heard about this, he was skeptical because he gets pitched every single day. But 15 minutes into this demo, he realized something. This could actually work. Resquared lets you reach local business owners at scale in a way that actually works. Ray's been using it for a few months now, and not only is it effective, but it's kind of fun. In just a few minutes a week, he's sending targeted messages to small business owners and getting real conversations started. Like the childcare owner he connected with that was looking to buy their second location with an SBA loan. If you ever considered connecting with small business owners and didn't have the right tool to do it, this is it. Resquared is offering a discount just for BDO Show listeners. So go ahead and schedule your demo today, and we'll leave a link in the show notes for you below.
Yeah, and that's why it's important as a BDO. It's more than just the debt service coverage. You got to understand the operating cycle of the business and the industry itself too. So that's what separates just a good BDO from like the people that are on this show, the great BDOs, understanding the operating cycle and liquidity needs of the business. And it's different for each industry. Retail businesses, point of sale, restaurants, things like that. Typically, you're going to have less of a liquidity need there because they're getting cash in real time. But if you're working with government contracts and things like that are 90 days, a little bit longer, that's when you need to start looking at that balance sheet and understanding how long is the operating cycle for this business and how much cash do they need and how much cash is staying, and read that purchase agreement. Like Kroge, I think he said that on one of the shows prior, like one of the first things he does is read through the entire purchase agreement. I'll be honest, these days I might skim through it, but I want to get back to that. And if you're a BDO and you're not reading through the purchase agreement with a fine tooth comb to understand what accounts receivable are transferring, what cash is staying in the business, if any, you should be.
By skim through
Right.
it, you mean slide the cursor over it.
No, and especially looking at
Single click
Open
the
it and
file.
see the number. Yeah.
Being here in the Rust Belt, right in the epicenter of the automotive industry, I used to, for a very long time, do a lot of manufacturing companies. And so accounts receivable and payables were huge in analytics when making a decision what level you will have a revolving line of credit and how much you were putting into permanent working capital as well. Because when you're talking about these type of companies that have net 30 to 90 days on their receivables, a lot of times in those contracts, if you're not reading them, you might get an aha moment. Whereas the first 1 million or 800 and whatever thousand in receivables that are on there at the point of closing go to the seller. I see that a lot of times, and a lot of times a buyer doesn't realize that, an attorney missed it, nobody looked it over. And as a banker, if you don't catch those type of things and you're like, all right, cash cycle's good, inventory turnover is perfect, right in the amount of days, but wait a minute, they've got $1 million in AR and 750,000 of that is going to the seller. That brings your $1 million in AR to build organic working capital in the next 30 to 90 days down to 250. And those accounts payable that are matching those ARs are not going to be equivalent. So you're going to have a big issue on your hands. That individual, once they take over, within 30 days, they're going to come back to you with a crisis. They're going to have an issue. They're going to be under 30-day past due report. They're going to have an early default, and nobody wants that to happen. We had a whole entire podcast on clawbacks, and that is a sure sign that you will get a clawback and you will have a failed business if you are not looking at that cash cycle and you are not paying attention to their liquidity and their accounts receivable in that purchase agreement.
And if you're a BDO and you don't quite understand, right? Some BDOs don't have a credit background or may be uncomfortable. Talk to your credit manager. Set up a meeting, pull up the purchase agreement, the tax returns. Hey, can you look at this before you issue that term sheet so you're knowledgeable about how to structure the deal and you understand the best way to structure that deal?
Does anyone have a good calculation that they can share for how they come up with a working capital need?
It depends on industry. For me, I do have one when it comes to my retail or my restaurants, but I also have one that I've used. I'm not kidding. I've used this spreadsheet for probably 15 years. It's an account receivable and account payable aging um, analytics. So what I'll do sometimes, if it's a really intense cash cycle, usually past net 30 on the receivables, and their payables are turning over 30 days, I'll get 12 months worth of accounts receivable, 12 months worth of accounts payable. I enter into the spreadsheet, and it'll spit out what their true cash cycle is, number one. And number two, I can take that very last piece and drop it down to what they're actually going to get at closing, and it'll spit out and tell me exactly how much liquidity, permanent working capital, they need baked into that loan in order to be able to get them to the cash cycle, to where they're organically generating working capital to make their payables.
Oh man, the next step for the BDO show is to start selling templates.
Well, the Mueller calculator,
Yeah, the
that
Mueller
is a download that we all make. It's called the
Yeah.
Mueller calculator. It's found anywhere good apps are offered or sold. Apple has the App Store. Google has something else, but it's called the Mueller calculator, and I suggest everybody check it out. It's really helpful.
The calculation it might be a little too convoluted for the show, but it's I'm actually reading it off a memo here so I can make sure it was right. But
Classic leadership.
the revenues minus net income. So you're looking at your annual. Yeah, I'm like, I don't know anything. Let me look it up. The annual expenditures, and you're breaking that down to your daily net cash expenditures, and you're multiplying that by the times your cash cycle is in days. So essentially, that's accounts receivable days plus inventory, and that's your operating cycle. So your AR time, your inventory turn times, that is what's called your operating cycle. And then you're going to deduct your accounts payable days. So, for example, if AR, and I'm doing a horrible job at this, and days in inventory was 90 days in total, and you subtract out your AP, which is 45 days, then your operating cycle is 45 days. And you spend $2,000 every day in that business. So 2,000 times 45, that would come up with your number. And I'm not going to do the math on that final calculation.
See, you're taking me back about 25 years to my undergraduate degree in my accounting classes. This is perfect, Professor Hackney. Thank you so much. That was a great explanation, and I'm not being facetious. I'm being serious. That's a really good.
I figured we would try to get a little technical, but if you do have questions,
listen, we need to provide more value. Yeah, we got to do this stuff.
Seek advice from an attorney.
Most credit departments will have a Moody's spread that they put all the information in, and that Moody's will spit out those calculations on where your cash cycle is, where your inventory turnover days, your accounts receivable turnover days, and it'll do a lot of those calculations for you. It's just kind of nice sometimes if you're dealing with larger, lower middle market, larger small business type of transactions in a manufacturing or a receivables type space, to be able to have different access to cash cycle calculations at your disposal to be able to more accurately put working capital needs together.
Shout out to our credit guys that are listening. That's for you. And with this kind of information and knowledge, I think I like our odds a little bit better for maybe winning SBA Podcast of the Year next year. I know we missed it this past year, but listen, I hope the judges are tuning in.
And speaking of credit guys, I gotta give a shout out to Eric Kaczynski, our SBA credit manager here. He listened to
shout out
the
Eric.
the last episode that aired, and I said, I was busy, so I gave this assignment to our credit manager so he could figure out bank statement analysis. He said, "What do you mean? I'm not busy?"
Yeah, I'm well aware of Eric's workload.
Thanks. Yeah.
But actually, Chris, you should start encouraging Eric to start doing those working capital calculations so we can start boosting up those loan amounts. Just something to keep in mind.
Hey, I wasn't going to get into that in this episode, but you do an extra $100,000 on each loan per year times 50 loans. Do the math.
All right. Well, great conversation so far. Let's go in about liquidity, obviously, but let's go into how we handle situations where our borrowers lack sufficient liquidity, but the deal is otherwise strong. How do we approach that? Sterling, what are your thoughts on that?
There's some different ways that you can approach this. What committee is always going to tell you to do is go find the rich uncle, as they call it. Do you have an additional guarantor with some strength that would be willing to sign their life away? Just kidding, but would be willing to sign the dotted line and help guarantee this loan for you? Maybe someone with some deeper pockets.
PG.
Yeah, want to PG this alongside of you. That is certainly one way.
Okay,
that
Emily, we see you.
Look at Emily with the lingo.
Yeah, okay, PG.
I would have respected her more if she said recourse.
I'm not a BDO, but I've been working in SBA lending since 2018, so it's not that long. But if I can't say PG and like know those fun little like acronyms, like who am I? I'm useless.
Ryan's saying recourse just for old time's sake.
We still use that phrase today, not for old time's sake.
Yeah.
Nobody does. Shut up.
I use recourse all the time.
Go ahead.
Anyways, another way that you can potentially navigate that situation is, I mean, you can essentially lend them working capital. And every bank kind of views this differently. Some banks view working capital lent as post-closing liquidity. Some just say that, hey, that's just more debt that they're taking on and they don't have any post-closing liquidity. But if a deal is really strong in every way except for the liquidity piece of it, there's always a way that you can skin that cat. And I think you usually see this in situations where oftentimes maybe it's somebody who works at a business who's going to be doing the acquisition from somebody they've maybe worked for the last 20 years, and they've been getting paid as an employee. They haven't been getting paid as an owner, so they don't have a very deep balance sheet. But they are the perfect person to go and buy that business and continue to operate it. And you shouldn't really let a little bit of a lack of liquidity get in the way of a good deal. So in those situations, oftentimes, you have to find a way to get creative with their equity injection. Maybe in the first place, maybe a seller will have to hold a note on standby for a couple of years. Maybe they will have to go find a small investor, but oftentimes you can also lend them some liquidity so that they have some post-closing that's going to get them through that hump.
And I think if it is a strong enough deal, and I think I said this a little earlier, put it in the loan. Put it in the loan. Make sure they have enough working capital. Make sure they have enough cash to be able to get them through the next 3 to 6 months after taking over a business. That is the crucial point to where they can get their feet on the ground and start doing it organically.
Yeah, and liquidity it's use of proceeds dependent and industry dependent as well too. So don't forget that. Like if it's a startup loan and you don't have the liquidity, that's a hard sell to me, at least, unless you've run one before, maybe you closed up shop or sold it. Now you're starting another one. So you've got the experience, but if you don't have the experience, or maybe you just worked in the business and you're starting a new operation and you don't have liquidity, I don't know how you really, you can bake in some working capital, but if stuff goes south, like that's a tough.
How would that go over in committee, Chris? Wouldn't go over very well, would it?
It would.
How would that go over in our committee, Alan? Oh, wait a minute. We don't have a committee. We have single sign-on authority because we're not in the Stone Ages.
Recourse,
baby.
Recourse.
Functional obsolescence. Let's go.
I'm still.
Is that what it says on your
That
term
is
sheet?
liquidity.
Recourse.
It does.
It's in all capitals.
You know it does not, but it will now. I am changing.
Guy did 84 million saying recourse
on every single
Talking
one of my
about
term
scaring
sheets.
away business. Talking about scaling back production. Gosh, recourse.
Mr. Kroge, what does this recourse word mean here?
I'm not signing this. No
I'm so
way.
glad you asked. Let's talk about it.
Before we end the episode, can everybody share an example of some creative liquidity solutions that you guys have seen in any of your deals? Like the most creative?
Yeah, I've got one that's going to close next week. I've got an individual down in Orlando who's acquiring a bunch of, there's 5 locations and it's a franchise of these dress shops for the retired season lady. And it's all just regular locations right now, but she's got a background in e-commerce and she wants to expand it and put it all online. So we did the acquisition plus added $500,000 in working capital so that she can expand, build her inventory, and take it nationwide.
So I recently did a deal where, it was a startup franchise. The person actually worked for the franchisor, so they were very good, very experienced, and had worked in stores previously. They were a little bit light in liquidity, and they were able to talk the landlord into giving them their tenant allowance on the front end. So that allowed them to essentially get the equity injection that they needed to be able to get the 10% that we wanted as a total project. And we were able to get that loan closed last Wednesday. So, that was a creative way to get some liquidity in your pocket.
Let's get that life insurance though.
Oh, the life insurance is it's done. It's we'll be in tomorrow.
That guy used his brother's life insurance company.
Chris, talk about some of the creative liquidity solutions that you've seen.
Creative liquidity situations. There were a couple last year where we actually did not use the borrower's liquidity for a down payment because it was an expansion loan. So with the new SBA SOP, you can buy a business, same industries, same ownership, same geographical region, with no money down. So rather than, we need 10%, like, okay, this guy can buy this business, keep his liquidity on his own. We won't have to lend additional working capital to. That's a better deal for everyone. So we did a couple of those structures there where sometimes it's not about like the liquidity into the deal. It's about how much liquidity can you preserve post-closing. So we thought that was a better fit. We were comfortable with based upon the cash flow. It was a daycare. 2 of them were daycares, actually. We had a lot of commercial real estate involved in the transaction. So we did a $3.4 million acquisition with no money down from the guarantor. And they kept their liquidity. That was, one of 2 deals I did last year. So there's that. But there it is. I still lend.
My man.
What about you,
Just
Alan?
bought a house. Just bought a big car. I need money. Send a loan.
Domestic. Welcome to the club.
Oh,
What'd you
terrible
buy?
decision. A Yukon Denali with no family.
Look at you. You just wanted to
bus.
flex.
It's a school bus.
Do you want one?
Bus.
It's just like you can fit 3 in there.
Is it an XL or is it shorty?
I went with the shorty. Yeah, an XO would have been ridiculous. Yeah,
well, we're gonna bring the Denali in my Suburban and wait out back of Tootsie's when the ICE officers run in the front door. We'll pick them up out the back.
Hey,
I had a deal
I'll
where
bring down my wife's Escalade. It'll be great. We'll have plenty.
I had a situation where a key employee was purchasing out the business that they had been running for years. And, because they were making a manager's salary and not an owner's salary, they weren't able to compile the necessary cash for a traditional down payment. So what we were able to do, because the seller had such faith in their key operator, and they really wanted to see the business transfer into their hands, they held a note that we were able to honor for the full equity injection. And that note was structured on standby for 2 years, interest only for 3, then 5 years P&I payments for a total term length of 10 years with no balloon due at the end. Now that structure allows the note to count towards the equity injection per the SOP, as you might not know, but I certainly do. That was a great deal. And, that was one way where they were able to, we looked at it as, we'd rather them have some cash on the sidelines post-close than overextend themselves when we already have the ongoing support of the seller. And with the key employee, we can ensure the continuity of key relationships, key customers, key vendors. It was a great deal, and I was really happy that we were able to get comfortable with it.
All right, guys, great episode today. Thank you for weighing in on liquidity. If you guys have any additional questions, any of our listeners out there about this, go ahead and shoot us an email to the BDO Show at artofsba.com. Smash the like button, subscribe, do all the things. And don't forget to check out our whole family of shows, including SBA Today, which airs live every single week, as well as our flagship program, the Art of SBA Lending Podcast. And we will see you next time.
Yay, yay.